Hello, I'm Russell Pointsman from Edison, and today it's great to have back with us Darcy Willson-Rymer, the CEO of Card Factory. Just released their full year results. Welcome back, Darcy.
It's nice to be back.
Why don't we start on the retail business? There were two things that stood out to me in the results. One is you talked about the space reallocation, the store segmentation, and the changes being made there. So could you just talk about what you've done and perhaps what's likely to happen in the future?
Sure. So first of all, I thought it was a really strong set of results where we announced growth of over 6%, both in terms of sales and profitability. But of course, the majority of our sales comes from our very healthy retail business, where we have over 1,090 stores across the UK and Ireland. And over the last few years, we've been evolving the offer through a combination of looking at range, space, display, and service. So when it comes to what we've been doing on display, we've been looking very hard at the space allocation. So what space we allocate to cards, to gift, to celebration essentials, and making sure that we have the balance right. And so what we've been doing is continuing to grow card sales, but disproportionately growing attached gifting and everything that you need for your celebration. So last year, despite the fact that we had reallocated 7% away from card to gift and celebration essentials, last year we continued to grow card sales. So our card sales grew by nearly 1%. So that's in a flat market. We continued to grow our value and volume share. But our gift and celebration essentials, we grew disproportionately by 5.7%. And that's combined, which is what gave us our like-for-like growth of nearly 3.5%.
And is there much more to come on the reallocation?
So I think there was quite a bit of, there was catch up to do when we did a sort of fairly substantial change across the estate. It was nearly 900 stores. We're now in a sort of more business as usual mode where we continually evaluate what space we give to each range and the subcategories within it to do two things. One is to maximize the sales and profitability per square foot, but also, more importantly, is to make sure that we've got the compelling offer that our customers want to buy, whilst also dealing with a shift in of what's going on in the market.
Right, okay. And from a product perspective, you do mention in the results release about the good, better, best pricing. So just talk about what is happening there. Is there much more to come on that? Do you have pricing power, I guess?
Yeah. So first of all, I think it's a bit slightly differently than good, better, best. So we're very clear on our pricing architecture. So if I take cards as an example, our entry price point is 29p, and it's been 29p since the inception of Card Factory. We then go up to 49 and then 50p increments, 99, 149, and then we exit the market at 3.99. And when I joined the company, the exit price was more like 1.99, maybe 2.99 in the season. So we've pushed the exit price. In our recent relaunch of wedding product, we've stretched that even further. But the point of having that architecture is we help our customers celebrate their life special moments at any price point that they want to spend at. But what we're clear at each piece of the architecture, so a 49 pence card, when you pick that up, it's going to offer unbelievable value. And it's the same if you pick up a 3.99 card, it's got substantially more value than a 49p card. It's got a lot more words and foil and embellishment. But when you pick up that 3.99 card, it's going to be the best 3.99 card in the market. That same card will sell, £5 and £6 in other places. So it's just about making sure we've got the clear architecture against the products that our customers want to buy, and that at each price point, we're the best value in the market.
Okay, thanks. So moving on to online, there were a couple of things that stood out to me in the results. One is obviously the closure of Getting Personal, so I'd say something about that. But then also in terms of the online, I think you said you're reducing the stock cards, going to more personalization. So just tell us what that is, what customer behavior has driven that. So two parts to that question, really.
Sure. So first of all, we continued to evolve the online offer last year. So continued to improve our site and a lot of testing. And we're very clear on what the drivers of growth and drivers of profitability are. And so it gives us confidence that we will continue to invest and get our fair share of the online market. Getting Personal was a loss-making business that needed to be dealt with. So we closed that at the end of January. So our focus going forward is on cardfactory.co.uk. It's important to know in the history that when cardfactory.co.uk was set up, it's set up with some personalization, but selling all of our store stock products. And so therefore, what customers were doing was buying some store stock product, maybe some personalization. We were then sending it back to them. But it's very difficult to make money online with our store stock product. And also, we don't want to see sales transfer. And so our focus going forward is on a personalized print-on-demand card, which is direct to the recipient. And of course, that will come with attached gifting. So we expect attached gifting to grow off the back of that. So that's that's mission one. So direct to the recipient with attached gift. And then mission two is then going to be focused, which is in the future, around celebrations and how do we curate range for anybody's celebration that they might be having. So the launch of Click and Collect last year was the first step in that sort of omni-channel journey. We are in test now with balloon appointments. So you'll be able to go online, say, I'd like this type of balloon art or this type of balloon bouquet for my party. Choose what day you want to collect it, what time you want to collect it, what store you want to collect it from. So that's in test now, and we'll continue to build out that sort of celebrations mission.
Okay, and just a side question. I mean, I've been up to your Printcraft site in Yorkshire, and the ground floor is pretty full. That's where the cards are printed for the shops, etc. But upstairs there's a big empty floor with printing machines. So it struck me that you have quite a lot of capacity to do this without a lot of incremental investment in infrastructure. Is that a fair conclusion?
Yeah. So in terms of the print on demand, we have all of the infrastructure we need. We will, and with the capacity, so we will be able to continue to do what Card Factory is best at, which is competing on value and offering brilliant value for money, to the customer.
Okay, and going back to cardfactory.co.uk stuff, I think it grew by 0.1% or something in the year. It was relatively low growth. Could you just? I mean, I know people are probably, whether they're too obsessed with online growth versus the retail. When can we probably have to look forward to better growth there? I know it's this balance between growth and profitability, right?
Yes. So look, I think one of the things that we've been doing is slowly removing store stock whilst we drive up personalization, and that rebalancing is going to take time. I don't think it's appropriate for us to just sort of rip the Band-Aid off, because we'll probably see perhaps it going backwards. So I think the strategy is clear. What I will say, though, is in the UK, by volume, 90% of all cards are sold in a physical store, 15% by value. So the vast majority of cards are sold in physical stores. And we absolutely believe that will continue long into the future. Now, the online market is growing off a very small base, and our intent is to take our fair share of that market.
Great, thank you. All right, let's move on to partnerships. The key, there's been lots of activity in partnerships over the last 12 months. One thing that stood out to me was this in the Middle East, where you effectively changing what you're doing, moving from
franchise
to the sales. What wasn't really working in the Middle East?
Yeah, so let's take a step back.
Yeah.
When we launched the partnership strategy, we tested a whole pile of things, and we have a culture at Card Factory of test and learn. And so we tested a wholesale model. We tested a wholesale model where we fulfill, where the customer fulfills. We tested white label, and we tested franchise. So we did all of that. Our conclusion through all of that is the main model that we're going to go forward in our partnership program is a full service wholesale model where we work with our partner to curate the range of card, gift, celebration essentials, and then effectively on card we will do the merchandising. So that's the model going forward. Specifically to the franchise, effectively, there's two really key pieces of learning. First of all, if you take the Card Factory brand into a market where that brand doesn't exist, we can grow the brand, but it will take longer and take more investment to do it. And the second piece of learning is where you're a gift-led customer journey. So in the UK, typically in North America, it's card first, whereas in the Middle East, it'll be gift first. And of course, if you're then leading with gifts, it's a different type of gift that you need to have, and it would be a completely different type of range. Now, again, we've got the skills, the expertise to do that, but the time and the investment required to do that. So our conclusion is the wholesale model is the right one for us going forward. Of course, the most exciting thing is what you haven't asked me about, which is about the test that we're doing in the US, where we with a retailer, we tested a very small range, sort of 40 to 50 Christmas cards on a freestanding display unit, which we manufacture in the UK, shipped to the US. A lot of learning on how to work in the US, how to work with 3PLs, how to get stuff into 49 states, 1,100 stores to the back door, all of that kind of stuff. We repeated that Valentine's Day, Mother's Day. But where we are now is we have got just shy of 100 stores, so 93 stores, in an everyday trial. So we've got a full range of card offer alongside an incumbent supplier, and we get to see exactly how our product resonates with the US consumer. So again, along the lines of our test and learn, slowly, develop the right offer, but do it in a profitable way from the outset.
Right. So apologies for not asking about the US.
Oh, no.
So let's move on to just some general corporate questions. First of all, a bit like last year, you're pointing to a second half weighting of profit versus the first half. And last year, that there was a bit of nervousness which was reflected in the share price rise in terms of whether the half two profits will come through, and you delivered on that very well, as you said you would. So looking into this year, what is driving the H2 weighting this year?
Yeah, it's very simply. So if you think about, so our sales are weighted to the second half. So in the first half of this year that we're in, we have the full year effect of last year's national living wage, and then the start of this year's living increase plus the national insurance and the general inflation. And, inflation at the moment is running significantly higher than it has been, historically. The opportunities to offset, there's greater opportunity to offset in the second half, given a combination of just the sheer volume that we do, but also with Christmas being quite a substantive season for us, the ability to adjust range and adjust price, etc. So all of the plans that we need to have in place to continue to offset inflation are in place. We talked about how we've taken our approach and our methodology to structural cost savings. So we've packaged that up into a program called Simplify and Scale, to help colleagues engage and fully understand that. That's multi-year. It's not just last year and this year, where we identify whether it's process, whether it's systems, whatever it is, to drive your sort of innovation and productivity. And we will continue to use the levers of productivity, efficiency, and range change and pricing. So utilizing all of those levers to offset inflation. And I think one of the things that we're particularly proud of, if you have a look over the last 3 years, the year we're in and the preceding 2 years, we've had 60 million pounds of inflationary costs coming into the business. And we were a 66 million PBT business last year. So if unmitigated, right, there would be no profit. And the fact that we've continued to grow sales, continue to grow profit whilst offsetting nearly 60 million pounds of inflation, the team have done an absolutely outstanding job. And we will continue to work in that way.
That's great. Thank you. So let's talk to the capital allocation policy. So we're back into dividends, and I know there's certain investors would like share buybacks, certain investors prefer dividends. So can you just talk about what the capital allocation and how you're thinking about those?
Sure. So first of all, acknowledge that there's many voices in the debate about what's the best way to reward shareholders, and acknowledge that different investors have different requirements and have different preferences. And so we kind of acknowledge that and understand our shareholder base and what the different requirements are. Our capital allocation policy, I think, is very clear. We reinforced that about a year ago, and there's 4 principles that underpin it, which is maintain a strong balance sheet, invest in the future of the business, have a progressive dividend and a progressive way to return cash to shareholders, and then finally, if there is any excess cash, it's about the discipline that we have with cash, and if we have any excess cash, is to return that to shareholders. I think when we reintroduce the dividend, I think that's widely acknowledged that was the right thing to do, to reinstate the dividend and to make it a progressive dividend. And if we have excess cash, all options are on the table for the board to consider in the different ways that we could return that. But fundamentally, the focus of the business is to drive the top line sales, drive profitability, convert it to cash, and make sure that we balance out the experience of the customer to get them best value in the market, reward our colleagues for all of their hard work, but reward shareholders for their capital and for their patience.
That's great. Thank you. And finally, we've talked about all the individual bits in the company, but you just published your results. So what do you think were the key takeaways from the results this time?
Yeah, so look, I think it was a strong set of results at growth in sales and adjusted PBT of over 6%. We see our store estate continues to grow and deliver the results. We have more work to do in online and again partnerships kind of moving along. I think as I think about this year that we're now in, we're off to a good start. So pleased with Valentine's Day and Mother's Day. So that was in line with our expectations. We've got all of the activity in the pipeline, whether that's to continue to drive sales in store, with range, with display, with service, and we're confirm our expectations to grow profit by mid to high single digit this year, and we go again.
Darcy, that's great. Thank you for the rundown of the results and what's happening in the business, and good luck for the coming year.
Brilliant. Nice to see you again.